Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Tuesday, December 3rd, November review. I Shot The Tariff. One of our guys came up with this funny name, Wall Street Research, sell side. People love to do this with songs, so we figured we'd give it a shot, and we'll talk about why a little bit later. But let's look at the land of gains. It's just been a record-breaking year. I think today is like the 54th or 55th new all-time high in the S&P. So the question begs, can this continue next year? Or have we pulled forward a lot of the returns based on expectations of loosening Fed policy and also some Trump positive economic outcomes, perhaps? So here are those Trump trades. Russell 2000, the top left looks like it's making a new high. S&P financials making a new high over the last 5 years here. Some of the Trump trades have backed up. This is the I Shot The Tariff, I think, with Bessent being nominated to the Treasury Secretary. You've seen some of the fervor around tariffs back off a little bit, so rates have come down, and you've also seen the dollar stop advancing so much. Now, as we look at equity markets, I mean, it's just remarkable, this chart. The worst performing equity index here is still up 8.6%, the FTSE 100. The Nasdaq in the far left up almost 30%, S&P up almost 30%. Russell 2000 after lagging up 21% now year to date. So just an epic year for equities. We saw a little bit of a pullback in that Mag 7, but just roaring back through the end of the year. And the equal weighted index and the S&P 500 also catching up to those big mega cap leaders. Looking at tech and small caps, it's kind of going sideways as both Nasdaq and Russell 2000 have been heading higher. So we're seeing this chart go sideways. Looking at the breadth of technology, S&P Infotech Index versus the equal weight, we can see that this is also going sideways as both those mega cap names and the smaller names in the infotech sector are all doing well. So this chart also going sideways here. And the speculative fervor. Bitcoin's kind of stalled out a little bit. But you can see that there's been this huge run up in some of those more speculative parts of the market. We looked at ARK last time on the bottom left, continues its march higher with the Nasdaq. Tesla taking a little bit of a breather, but a big move off the lows it's on. Of course, everyone's favorite Dogecoin also having that parabolic move up. Commodities going sideways. Still, I think there are some concerns around global growth, especially with expectations of more tariffs. So you're seeing the U.S. do well, and the U.S. exceptionalism mantra is out there. This is why the dollar is doing so well. But as you look at other parts of the globe, or maybe expectations of emerging markets and other developed nations in Europe, things are not looking as rosy. So commodities have kind of gone sideways to even down. It's really just been a story about precious metals. Here you can see that on the far left. Gold up almost 30%. Almost up as much as the Nasdaq. Silver up 27%, and then it's kind of a mixed bag with energy barely up and natural gas actually down 20% on the year. And natural gas is a big component of some of these indices, which is why you're seeing that sideways to downward movement in the commodity index. After a pretty meaningful sell-off, rates have caught a bid. They kind of hit a trend line. I don't have it here, but if I drew a line from the high of 23, which was about 5%, through the high earlier this year, which was 470, you got to right around 450, which is where the market stalled out. It happened to coincide with the Bessent news, but I think that was a pretty big technical point, and that's why you saw the market rally off that news. And I think we get some new inflation data. We got jolts today that kind of job openings were up, didn't really move the market too much. So we got some data prints coming up that maybe will help drive the direction of rates, both some employment numbers and also, of course, the inflation numbers coming up. Credit continues to grind tighter. We're maybe slightly off the all-time highs in the corporate credit markets, both investment grade and high yield, but we continue to see the securitized and bank loan markets continue to grind tighter and play catch up to both investment grade and high yield. Inflation expectations, they had spiked earlier, which had one of the reasons that rates are rising is people are expecting the new red sweep would increase inflation. That's taken a little bit of a step back. maybe the investors, wondering maybe we've gone too far too fast, and we still don't really know what's going to be rolled out. The Bessent nomination again moderated some of these speculations of just extreme actions by the administration. So you see break evens up a lot off their lows, but coming back a little bit down with rates coming down as well. This also coincides with economic data. This is the city surprise index. You can see that it moves in line with rates and economic surprises. While still positive, the pace of positivity, I guess, has been coming down. And you can see that rates have moved with this. So I think that if we see some weaker data, that could help fuel a bond rally into the end of the year, beginning of next year. We're about to get that data. So the next couple of weeks are pretty critical with thin trading. You can see some market moves due to the thin trading that's out there. This is more of a global look. And we talked about this moments ago, that in some areas like the euro area is in the blue, and that's been having negative surprises to the downside, which is why you see this dichotomy between the US kind of perhaps not cutting as much, but the EU moving ahead as their inflation continues to come down and their growth continues to slow. So they're, I think, more concerned with growth, and they will probably continue their path lower with monetary policy. China kind of going sideways, helped by stimulus. We saw the US earlier that had come down, and emerging markets is kind of going sideways right now. So what's happened in the bond market? Well, a lot of the repricing in the forward curve of Fed funds is we already saw last month, so that not much has changed. Maybe it's come down a little bit. Just in September, we thought we'd be down at 2.8% on Fed funds by the end of next year, and now it's more like the high threes, 380, I think, as of November 29th, so last week. The yield curves, the 2s, 10s has basically flattened out. It had gotten steep ever so slightly, and now we're basically almost flat. 2s, 30s remain steep. I think we've had a view of a 2s, 30 steepener, and it's been it hasn't worked very recently. It's worked from the beginning of the year, and we like that type of positioning, just given the potential fiscal risks coming down the path. But I do think that if the data comes in weaker, we could get a little bit more of a bond rally here. Fixed income spreads just tighter across the board, tighter year to date, tighter month over month, except for I guess EM Corp's ever so slightly wider, but being down 62 basis points on the year, 5 basis points is nothing. So it's just been a great year for credit. It's been a place to be. The riskier the credit, the better. The parts of the market that lagged last year played catch up this year, just as we had talked about many Channel 11s ago, and it's all playing out as we expected. The question is, what now? With spreads tight, uncertainty around inflation perhaps picking up, uncertainty around growth maybe picking up. What's going to happen with that longer end of the yield curve? So it's giving that back up. Maybe it's giving investors an opportunity to add a little bit diversification and diversity to your portfolio. So fixed income returns from November, pretty positive month outside of levered loans, levered loan triple Cs, which is it's odd because high yield triple Cs have been doing really well, but I think the levered loan triple Cs are have a little bit more risk. A lot of the risk in the high yield market moved to the bank loan market over the last couple of years. So about 1% return for the highest returning sectors because of some of the duration moves, but then we saw the sell-off. This is through November 29th, end of November. The ag on the far right up 2.9%. Agency mortgages up 2.8%. Corporate bonds up 4%. So that's okay, I guess, for fixed income. But if you're actively looking at an active managed fund, they're probably up about 100 basis points or more over the ag. So that's something like 4.5% return. So I guess that sounds okay, but T-bills were 5 this year. So you had a pretty wild ride up and down in intermediate term funds when you could have just grinded out in T-bills. That gift is kind of slowly going away as the Fed cuts. So really the place to have been was credit, and credit not doing as well as equities, but a basket of credit is up probably anywhere from 7 to 9%, depending on where you were. What's our outlook? Well, we think credit can continue to do okay in this environment. There's not as much spread tightening room in the corporate credit markets. The securitized markets still have some room to catch up. But you're just going to earn out that yield, and you can still find, mid-single digit yields for investment grade assets. You can find almost high single digit yields, call it 7 to 9% for, the upper echelons of the below investment grade market. So we find both those sectors interesting. It's all about portfolio composition and depending on what else you own in your portfolios. Three cheapest part of the market here we see in the top left on the high quality side. Agency mortgages, that lone wolf we've been talking about that has lagged the rest of the market. So room for improvement there when the banks step more meaningfully in. That could happen because the Fed cuts. That could happen because of deregulation under the Trump administration. CMBS and RMBS, we believe, will continue to play catch up along with ABS. Everything's basically moving down and to the left. Even CMBS triple Bs have had a huge rally. They're one of the top performing assets this year. This index of triple Bs has some of these legacy bonds that have issues with office. New triple Bs that are being issued today have less office exposure and don't trade as wide. So there's some nuance to why this dot in the top right sticks out so much. And last but not least, the CAPE ratio that we've been looking at continues to grind higher, 92nd percentile at a CAPE ratio of 38, which is basically showing historically that generates barely any return. And so fixed income might be interesting there. Now, this doesn't mean that stocks can't continue to grind higher. There's always growth and innovation. So, I think I still like stocks. I think they're a good inflation hedge. But the case for bonds versus stocks, given that bonds have lagged and stocks have ripped, continues to make the case for adding some more fixed income into portfolios. So we'll end it there. We're going to skip December. Hope everyone has a great holiday season, and we'll see you in the new year.